Hello friends, welcome to learning sessions, and today in this video we are going to start with the investment management that is actually related to module D of the RBWM, that is a retail banking and wealth management. And if you are going to prepare for the JAIIB 2024, you must be watching this particular video till end, because we are going to cover amazing topics and amazing stuff related to the RBWM in the minimum time, so that you can cover the whole syllabus in just 7 to 10 days. Yes, you heard it right. If you want to cover the full syllabus in just 7 to 10 days, just do follow our videos. Those are available on our YouTube channel. And further, if you're unable to find the videos on the YouTube channel, you can be visiting our website jaiib.learningsessions.in. The link is available in the description over there, and simply sign up over there, which is absolutely free. And on sign up, you'll be getting access to all the PDFs over there related to all the 4 papers of JAIIB. So do sign up over there, enroll to the course which is available. We are also providing the JAIIB Mahakumbho course, where we'll be covering all the 4 papers of JAIIB, the chapter wise full course videos, chapter wise previous questions, memory called questions, mock test, mega mock test, each and everything will be available over there. Just do enroll over there and start preparing for the same. So let's start the session over here, and it's related to the investment management. Now, what do you mean by investment management over there? Let's say the case that you are having a pool of money or funds over there, and you basically want to allocate those funds, those resources, capital into the different assets. Let's say case I'm having 100,000 or 100k over there. I want to basically invest into different things. Now, how I'll be allocating into different assets, into different capital versions over there, or different projects over there. And definitely I'll be expecting that I want to earn something out of the same, so as to generate the income to profit, or I want to basically appreciate the value of my portfolio or capital over there. That's actually related to the investment management over there. Now, the individuals and the organizations which are having the surplus money with them, definitely they do want so as to invest into the different type of securities, into different type of assets, whether it's related to gold, real estate, or bank accounts, even the debt securities or something like that. So basically that's related to the investment management over there. Now let's understand the different elements in the investment. First of all, it's related to the principal or initial investment. Like I told you that I'm basically ready to invest 100k rupees over here. Now in that scenario, 100k is representing the principal amount, that the basic principal amount that basically we started with, and further that's the principal amount over there. Now that is actually the amount that investor initially commits to an investment over there, and it's just what, it's the starting point of the investment. Let's say case when I started my investment, I was having a sum total money of rupees 100k, so that will be my principal amount and the starting point over there, over which the profit returns will be generated. And after that, it's related to return. Now return is actually related to return on investment, that I invested rupees 100k. Now what return I'm getting? Let's say case I'm getting a CAGR, a return of 12%. In that scenario, I'm having the total overall return of 12% on annual basis over there. Now in that scenario, let's say I'm generating rupees 12k or 12,000 over there, so that is the return that I'm getting over there. It can be in the form of dividends, it can be in the form of the interest over there, or in the way of capital appreciation, or it may be the rental income also, right? And also with every investment, now I have invested rupees 100k, and I have not invested into 100% foolproof particular, let's say, methodology over there. Now it may be the case that there are some of the risks associated, that the value may depreciate. Let's say case that you have invested into mutual funds, or you have invested money into the equity or the stocks over there, or the debt securities over there. Now definitely there are many risks which are involved. It may be related to the price risk, it may be the market risk, or the credit risk, or the default risk, or the various type of risks are actually there, which may be imposed on your investment. So that is actually the possibility of the loss of value or uncertainty related to the particular return associated with the investment over there. That is a risk. And after that, the different element, actually it's related to the liquidity. That's the fourth element. Now what do you mean by liquidity? That let's say case I'm having a security, and particularly went to the market so as to sell it, but let's say I'm not able to sell this particular security. It means what? It means the investment is illiquid. It's illiquid over there. Now how readily a particular security or particular investment can readily be converted into cash without the significant loss in the value over there? That is actually the capacity to liquidate that particular security or value over there. That's the liquidity, right? So these are the different elements of investment. First of all, principal, return, risk, and the liquidity, right? Now after that, now let's understand the different objectives of the investment. Now first it's related to, definitely we want to appreciate our capital. Previously I was basically having 100k, I want to basically appreciate the value, I want to maximize my return, I want to minimize the risk, I want to diversify. Now what do you mean by diversify? Let's say case if I'm investing my whole money in just stocks, in that scenario if the market scenario is negative, my overall capital value will decrease. Now what if I have basically, let's say 25%, particularly I have invested in stocks, 25% in the debt market, 25% in real estate, and 25% in, let's say, some alternative investment fund over there. Now in that scenario I'm quite diversified. Even if one of the particular pillar goes down, it may not be the case that the all will go down. Okay, so I can be safeguarding, I can be hedging my particular risk factors over there. That's particularly saving yourself from the concentration risk over there. That's possible by the way of diversification. And the other liquid objectivity is related to the liquidity, because I do definitely want to invest into different resources, but I want the liquidity with me also, so that if I do need money later on, I would be basically able to get the same. That's basically possible through the liquidity only, right? And other than it's related to hedging against the inflation. Now definitely inflation is there. Let's say the case today the value of this particular marker is 20 rupees, and let's say after 10 years it may be available for rupees 50. Now this is not the case that the value increase, but this is a general increase in the prices of the raw material or the input cost related to this particular market over there, and it's also imposed on the other sectors and the other things of the society over there. So we have to safeguard ourselves, otherwise our monetary value, our capital value will deteriorate, and I want to safeguard from myself from that particular thing. And in that scenario we must be keeping an eye on the same. And further related to real estate, whether we're talking about, or related to the precious metal like gold over there, right, we want to basically save ourselves from the inflation, right? And further it's related to retirement planning, it's related to the retirement planning. Now definitely many investors do save money, they basically do invest money, because the main goal is actually related to, they want to save themselves, they want to ensure the financial security in their retirement time over there, right? So these are the major objectives of investment, that I want capital appreciation, I want to maximize the return, I want to minimize the risk, I want to diversify liquidity, I want to hedge myself against the inflation, and also for the retirement planning purposes. Okay, and after that it's related to the investment management, it's related to investment management. Now what do you mean by investment management? It's a professional practice where a group of professional or individual professional, they will be managing the investment processes over there. That's related to investment management. That is said to be the investment management. They will be making the strategy, they will be making the strategy related to saying that what processes are to be followed, or what things are to be done, and what decisions are to be done over there related to the assets or something. And these decisions, these strategies will be made on behalf of the individuals who are going to basically take the investment services. So the individuals, so these services will be given to the individuals, organizations, corporates, institutions over there, and a group of professionals will be making the strategies and decisions for the same. That's the investment management over there, right? Now what are the different steps involved in investment management? First of all, it's related to goal identification. Let's take the scenario that being an individual, I want my capital to grow, and particularly I basically visited a investment management company, right? And they offered me some things, but before offering me something, they will be identifying that what is my goal, what do I want, right? They will be preferring to basically inquire for the same, right? And the other one that's related to, let's say case, I basically said that I want to invest 100k, and particularly I want capital appreciation over there. Now based upon that, they will be allocating this particular amount into the different assets over there, right? They will be having the proper mix. Now what is the actually related to proper mix? Like I told you, they won't be investing in just in one particular thing, but they will be investing in different things. Let's say case they invested some amount in equity, some amount in stocks, some amount in securities, some amount in debt part over there. So they basically invested the amount into different things over there, right? And also they basically said that they will be investing 18% in this, and further they will be investing, let's say 20%, 22% over here, and they will be investing 40% over here, and particularly they said they will be investing 20% over there, right? That is the thing they said. Now after basically after selecting the proportion of the assets they are going to invest into different terms over there, different things over there, they will be selecting the securities, that in equity, in what securities or what combination of securities they will be investing the the money, right? It's related to the security selection over there. And they, based upon that, a portfolio will be built. Portfolio will be a mix of the different securities under the different things, right? That's a portfolio over there. Now a portfolio is created, and for the portfolio construction is there, and after that it's related to monitoring the portfolio, that will be evaluating the portfolio performance, that whether the portfolio is working as per the our particular guidelines or our particular trajectory over there, right? Yes or not? And based on that we'll be making the changes to it. That is actually related to revising the portfolio. So first step, it's related to the gold selection or gold particular identification. Other one, it's related to the asset allocation, it's related to asset allocation. And third, it's related to the security selection, and based upon security selection we will be creating a portfolio. That's actually related to the fourth step over there. And fifth one, it's related to evaluating the performance of this particular portfolio. And for the sixth one, it's related to revising the portfolio based upon its pros and cons, right? That's actually related to the investment management steps, right? And after that, it's related to investment banking. It's related to investment banking, that what do you mean by investment banking and what are the different terms involved in it. Now investment banking is a specialized sector. Now banking is something different, where basically you're helping in merger acquisitions, and further you're providing the services. A lot of plethora of services are being provided to the organizations, corporations, government, and the large institutions over there. And basically you helping them what, that you, so as to manage the IPO, so as for merger and acquisition purposes, and further providing strategic financial advice services. Okay, so basically you're helping the different organizations for the same. That is particularly said to be what, that is a investment banking. That is the investment banking. Now investment banking is totally different from investment management. Investment management is actually something different, where we are managing the portfolio over there, right? But investment banking is particularly something different, right? That basically helps in merger and acquisition, IPOs, providing strategic financial advice, etc., like that, right? Now let's understand the different services being provided by the investment banks over there. First one, it's related to capital raising. That a particular company, let's say XYZ, wants to raise the capital. Now that particularly visited an investment bank, that particular visited an investment bank. Now this investment bank will be helping the XYZ, so as to, let's say, launch IPO. So whatsoever the different things or particular let's say steps are to be taken, so as for launching the IPO, those steps will be taken by this particular thing. Okay, and it will be helping in the same, it will be helping them in debt issuance, for private placements, and all the other things, not only IPO, but so as to whatsoever the steps are to be taken for particular fundraising services, right? So that will be particularly related to the first service that will be provided by investment banks. And the second one is related to merchant and acquisition. Like let's say X basically is having the surplus money and they want to acquire some company, and let's say P is another company which is actually looking for some acquirer, right? So they are looking for each other, and investment banks will be working as a middleman for the same, right? So that's the second thing. And the other one is related to trading and sales. Trading and sales means what, that they actually do help so as to trade, so as to facilitate the trading of securities into various financial markets. They'll be acting as intermediaries between the buyers and sellers, and further they will be acting as executing trades, executing parties over there who will be executing the trades, right? And they'll be providing the market liquidity for the same. That's also main one purpose related to the investment banks. So one, it's related to capital raising, second, it's related to mergers and acquisitions, and third one, it's related to the trading and sales over there, right? And after that, it's related to corporate finance advisory. Now it's related to advisory service, related to strategic advisory service that will be provided to the companies on their financial matters, that how they're going to manage, how they're going to allocate the capital over there, what should be the capital structure, what should be the mix of the debt and equity over there, how can they can be optimizing the same, how the risks can be managed, how financial planning can be done. Those advising services are also provided. Other than that, they also help in risk management. Like basically XYZ companies there, they have already allocated their capital. Now they see that there is a lot of particular risk involved, like it may be the default risk, credit risk, operational risk, market risk, foreign exchange risk, or something, any type of risk is there, right? And particularly they took the service from the investment bank ABC. Now in this scenario, ABC bank can be suggesting them related to that how they can manage the overall risks over there, how they can be reducing the level of risk, how they can reduce the risk. Let's say case they are basically investing into derivatives, or particularly contra particular let's say marks are taken, particular contra trade is done over there. So there are different solutions for the same, and they'll be providing those solutions through which the risk can be managed appropriately. So when we are talking about the investment banks, whether it's related to capital raising, M&A, it's trading and sales, corporate financial advisory, risk management or something, there's so much things which can be done, right? These are the different services of the investment banks over there, right? Now after that, it's related to underwriting services. Now let's understand the process of underwriting first of all. Now what do you mean by underwriting? Let's say the case XYZ company wants to launch its IPO. Now, as per the SEBI guidelines, that is the Securities and Exchange Board of India guidelines, they say whatsoever the issue size. Let's say case for this case, the issue size is 100 crore, right? They basically want to issue shares amounting rupees 100 crore. Now, in that scenario, they say 90% of the shares at least must be subscribed so as to roll out this particular IPO, right? That's particular condition. Let's say that is one of the particular condition by the SEBI, that is actually 90% of the capital must be subscribed, otherwise you cannot be rolling out your IPO, right? In that scenario, XYZ particularly went to the investment bank or to some merchant bank over there, and they will be asking themselves to come under some underwriting agreement. Now what that underwriting agreement says, that let's say 80% of the shares were subscribed by the subscribers. Now there is a shortfall of 10% of the shares which are to be subscribed. Now let's say case XYZ is having agreement with the investment capital banker over there related to the 10% of the shares will be subscribed by the investment banker in case of shortage or in case of shortfall over there. Now in that scenario, if the 80% shares are subscribed by the subscribers, 10% shares will be subscribed by the investment banker, because there is a commitment, there is an agreement between the bank, investment banker, and the XYZ bank over there, XYZ company over there. So in that way, they can be safeguarding their IPO or their issuance of the particular prospectus shares over there, right? So that's actually meant to be the underwriting process. So underwriting process, it's actually a guarantee so as to purchase a specified number of securities at a predetermined price if securities are not purchased by the subscribers over there, right? So that's actually related to underwriting services. Now there are different type of underwriting services. Let's first of all look at it. It's related to the firm commitment underwriting. Now what do you mean by firm commitment underwriting? Here the underwriter commits to purchase the entire issue. Like they basically said that we are issuing 100 crore of shares. Now here the underwriter will be saying that they will be purchasing the entire issue, that they will be purchasing the 100 crores of the shares, and for the will routing it to the public over there. Now related to if there is any shortfall, if there is any shortfall on the end of the particular public, that let's say public only subscribed out of 100 crore, only subscribed for 85 crore over there or 85% over there. Now rest 15% will be lying with the investment bank, and that will be basically the liability, that will be the risk basically be taken care by the investment bank itself. That's related to firm commitment underwriting, that where the whole lot of securities are particularly subscribed or underwritten by the investment banker over there, right? And the second one, it's related to the best efforts underwriting. In case of best effort underwriting, as the name suggests, the investment banker will be making best of their efforts so as to basically make public, so as to subscribe to the shares, but they do not take any risk participation in the same. Let's say case that 89, that let's say case 89% of the shares were subscribed by the public. Now the investor bankers has made their best mark so that the public should be subscribing the particular IPO over there or particular securities over there. But for the rest downfall or for the rest shortfall, the investment banker won't be responsible. They won't be responsible for any kind of shortfall over there. That's related to best effort underwriting. So the issuer bears the risk related to any shortfall in the raising capital over there. That's the point, right? And the other one is related to mini maxi underwriting. Now mini maxi underwriting is actually a mix of firm commitment underwriting and for the best efforts underwriting over there. Now in that particular part, the underwriter, that is the investment banker, makes an agreement, that particularly agrees that a minimum quantum of particular shares or particular securities are to be subscribed by the issue by a particular investment banker over there. And other than that, the investment banker will be making the maximum of the efforts so as to basically make public subscribe maximum of the shares. Let's say case that the firm committee that they will be subscribing to 75% of the minimum shares, and after that they will be making maximum of the effort so that the 100% of the shares are or securities are particularly subscribed. That's actually the mini max, that because they basically guaranteed for the minimum and basically they guaranteed for the maximum too. They basically committed for the maximum too for by the way of best efforts, right? And after that, it's related to all or none underwriting. Now what do you mean by all or none underwriting? Now in that scenario over here, now in this case, the underwriter will be actually be agreeing that the underwriter will be selling the whole lot of the securities, and if the underwriter fails to do so, then it will not be selling any of the securities and no capital will be raised at all. That's actually all or none underwriting, right? So these are the four types of particular underwriting over there, right? Now let's understand the, or let's have a look at the organizational structure of the investment bank. Now we talk about the front office over there. Now front office is actually what? It's a revenue generating segment of the bank, and is actually responsible where it is interacting with the customer over there. It is basically included itself in the trading activities or sales or deal making over there, right? Now IBD is actually part of it. Now IBD is doing what? It actually handles mergers and acquisition. Now front office is having the IBD, that's actually handling mergers and acquisition, helping for capital raising, corporate finance services over there, and also it's having the department related to the sales and trading. So one, it is having the IBD, that is investment banking division. Other one, it's related to sales and particular trading over there, where it is selling and buying the financial instruments such as equities, fixed income, currencies, commodities, etc. And the third, it's having the research, where it's basically analyzing the things, analyzing the market trends over there, having collecting the insights related to market trends or the companies or investors over there, industries over there, so as to support the trading and investment decisions, right? So particularly we can say, if we talk about the front office, we are having the three things. One, it's related to IBD. Other one, it's related to sales and trading, and the third one, it's related to research, right? And research is actually supporting these two. Okay, so that's the main thing related to front office over there. And the second one is related to middle office. Now middle office, when we talk about, it's actually there for risk management. Major thing is actually related to risk management, and risk management through compliance, risk management through operational support, right? So it's providing operational support to the front office and also helping in compliance and managing the risk over there, right? So these are the three functionaries of the middle office. So when we're talking about the middle office, it's particularly supporting the front office, and further it's having the three things. One is related to risk management, other one is related to compliance, and the third one is related to the operations over there. These are the three things related to the middle office over here. Now risk management is related to what's are the different risks which are involved in the market, credit, operational risk, market risk, or anything risk. They are basically looking for the same and trying to inhibit them, trying to resolve them, trying to reduce them, trying to mitigate them, right? And when we're talking about the compliance, there are many regulatory or legal requirements that you need to comply with, right? So that is actually taken care by the this particular department. The third one is related to operations, like particularly handling the settlements or reconciliation, though that is actually handled by the operations segment over there, right? And the third is we are having the back office. Now back office actually related to what? It's related to administration. It's related to performing the administration tasks over there, and particularly it support functions so that the trade and transactions can be taken care smoothly, right? So that's related to the back office over there. So back office actually administrative over there. It helping in settlement and clearing. It's basically helping in accounting and management of the finance over there, and also providing the structure of IT and technology over there, right? So that's actually related to the back office. Okay, after that, let's understand the differences between the investment management and investment banking. Now I told you, if you understood that previously I told you, investment management is actually a professional group strategic method by which the professional are providing the services to the individuals and the corporates over there so as to manage their investment. Whereas in the case of investment banking, they're helping in M&A, capital raising, advisory services, corporate finance services, underwriting services, right? So that is the thing related to it. Now the focus of the investment banking is actually related to managing the portfolio or the assets of the client. That's the main major focus. And in case of investment banking, the focus is actually related to what? Where they're providing the financial services to the corporates, governments, and institutions. And we have already talked about the services over there. If we look for the client base, both are actually dealing with the particular. If we talk about the investment management or particularly investment banking, both are dealing with the corporates, both are dealing with the particular departments over there. But specifically, the investment management is dealing with the individuals, dealing with the institutions, dealing with the pension funds over there. Whereas the investment banking is majorly dealing with the corporates, big companies, institutions, government institutes over there, right? And particularly, are they involved in IPO? No, the particular investment management is not directly involved in IPO, but they can be investing into IPO. They can be investing into IPO, and further, they may be underwriting the new securities over there, right? And particularly, okay, they cannot be basically, if we talk about the investment management, sorry, they are not involved in underwriting or any kind of directly over there, but they can be having the exposure to the IPOs over there indirectly, right? But in case of investment banking, through the underwriting process of IPOs, they are actually involved in the IPOs over there. And if we talk about the investment types over there, they have been investing. Investment management are particularly investing in equities, commodities, precious metals. But if we talk about the investment bankers, they are dealing with IPOs, merger and acquisition, capital raising, new securities, and debt issuance, right? That's the thing. And if we talk about the responsibilities, it's actually related to that they will be looking into what are the requirements, setting up the goals, and identifying the things, and identifying the different assets where can be allocating, selecting the securities, creating a portfolio, and further managing the portfolio, and after that revising the portfolio. These were the things. But in case of the particular investment bankers, they are managing the debt issuance, security issuance, equity research, market handling, market making, or liquidity provision things over there. Those things are being handled by the investment bankers over there, right? So that is a different, right? And further, it's related to portfolio. Now, what's actually portfolio? Let me just tell you from the very simple point. Let's the case that a person is here and he is investing in equity, he is investing in debt instruments, he is investing in real estate over there. All right, now in equity he is having different 8 securities, in debt he is having 5 securities, in real estate he has invested into 2 properties, right? Now that particular purpose, that all together all these particular things will be creating a portfolio, right? So it's actually, portfolio is what? Portfolio is collection of financial assets which have been invested by an individual or institution or entity over there. So these particular assets could be related to stocks or debt instruments or bonds or mutual funds or exchange traded funds or real estate or commodity or anything, right? So particularly main fund is related to what? That through a portfolio we want to achieve our financial goals, we want to basically diversify our risk, that is to manage risk over there, and we definitely potentially want to grow, right? We would basically need to generate returns for us, right? That's the main funda related to portfolio over there. And what do you mean by portfolio management? The portfolio management is a strategic management service which is being provided, that is by which the professionals are trying to optimize the portfolio over there, that whatsoever the risk in the portfolio is there, they want to reduce that particular risk, and particularly they want to increase the returns over that particular portfolio so that the financial objectives can be achieved, right? And what are the different particular steps which are involved in portfolio management? One, it's related to identify the objective. Let's say case person A visited to you, he wants his portfolio to be managed. And that scenario, first of all, we must be identifying what is objective, what is his objective, why he is here, right? Second, it's related to, we must be estimating the capital market, what is the main capital size market over there, right? What is the current economic and market conditions, right? So that the potential opportunities can be looked into, and what are the different risks involved, those can be looked into. And the third step is related to that what assets we must be allocating the money into. And fourth one, it's related to formulating the suitable portfolio strategies, that how this portfolio can be managed. And the fifth one, it's related to selecting the profitable investments and the securities. And for the sixth one, it's related to, we'll be implementing the portfolio. Sixth one, it's related to, we'll be evaluating or revising the portfolio. And eighth one, it's related to rebalancing the composition of the portfolio, right? So these are the different steps. So first step, it's related to what? It's related to identify the objective. What is the objective of A? What is the main goal of A? Identifying the same. Second one is related to what money he wants to invest. It's estimating the capital market. What are the different risks? What are the different opportunities basically right now there in the market? That's the second step over there. So the first step is the goal. Second step is related to market checking, that is market analysis. And the third one is related to that in what the different assets we can be investing, that's the asset allocation. And the fourth one is related to portfolio strategies, that we will be selecting portfolio strategies, that what type of portfolio should be managed, that so that it can be managed effectively and efficiently. And fifth one, it's related to, we will be selecting the different securities or different investments over there, right? And particular different investments and securities will be selected. And 6.1 is related to will be implementing the portfolio. Now the implementing the portfolio is related to portfolio is now there with you, right? And the 7th one is related to you will be revising the portfolio. You will be revising the portfolio, you will be evaluating the portfolio, or we can say simply we will be monitoring the portfolio. And for the 8th one is related to what? 8th one is related to that we are going to revamp the portfolio based upon its performance. Nah, that's the main thing, right? That's these are the different steps involved in portfolio management. Okay, now after that we are having the types of portfolio management services. Different type of portfolio management services. One, it's related to discretionary portfolio management. Discretionary portfolio management is actually a service where the portfolio manager is giving the is having the 100% access. So the portfolio manager will be making all the decisions themselves. The person will be having the all authority so as to select what type of securities or investment they can be investing into, and further so as to decisions related to selling or particularly acquiring the different assets over there. Those all steps can be easily be taken with the easy authority of the portfolio manager. That's the discretionary portfolio management. And what do you mean by the non-discretionary portfolio management? Where the portfolio manager is particularly provided the management, but the ultimate decision lies with the investor only. That's a non-discretionary portfolio management. And active portfolio management means what? Where there is actually quick, or we can say prompt buying and selling of the securities. It's not the case that the particular portfolio manager will be buying in one day and will be selling the other day. No, that's not would be the case. But in the case of active portfolio management, this will happen. There will be frequent buying and selling or adjustment of the investments over there, right? That's actually managers will be relying on the research they have made or the market trends over there, or forecasting or identifying the opportunities or the market risk over there. Based upon that, they will be making the things and will making the changes in the system over there, right? And further, it's related to passive portfolio management. Now passive portfolio management is actually related to where we try to replicate the performance of some active market index. Let's say case Nifty is there, Sensex is there. We want to basically benchmark them, and we will be trying to replicate the growth associated with those benchmarks or those indices over there, right? That's actually related to passive portfolio management. We are actually not trying to make frequent changes to our portfolio. Okay, so that's passive portfolio management over there, right? So there are four different types. One is related to discretionary portfolio management and non-discretionary portfolio management, active portfolio management, and passive portfolio management, right? After that, let's have a look at the role of the portfolio management. Role of the portfolio management. Definitely, what is the role of portfolio management? You'll be getting the help so as to you can diversify the risk. Previously person A was investing into one stock only, but now person is investing into different type of stocks and also into different type of securities and investment. Now the risk is diversified. The portfolio manager himself or herself will be monitoring the overall portfolio. Overall evaluation will be done by the portfolio manager, and for the portfolio manager will be helping them in such a way so as to reduce the tax liability in a legal manner, and further there will be disciplined approach in investment. It's not the case that today we'll be investing this much, so there will be disciplined approach in the investment purposes over there, which will gradually will be upscaling the particular portfolio and further will be giving you good returns, right? And further, it, as I told you, portfolio manager is managing, so there is actually professional expertise which is involved, right? And they are working based upon research they have made, right? They're not basically working as such. So that's actually the difference. That's actually about the role of portfolio management. Now let's understand the differences between the portfolio management and the investment banking. Now, in case of portfolio management, the person are trying to manage the portfolio of the individual or the institution, whereas in the case of investment banking, they are doing the merchant, they are dealing with the mergers and acquisitions, capital raising, risk management, etc., right? And further, if you look at the client type, in case of portfolio management, it is individual institutions, whereas in case of investment banking, it's government institutions, PSUs, high tech worth companies. Okay, so that is the thing related to it, and the objectives are related to maximizing the return while managing the risk of the portfolio over there. Whereas in the case of investment banking, they are assisting their clients for financial transactions and the strategic decisions over there, right? If you look at the key activities, it's related to asset allocation, security selection, risk management. Whereas in the case of investment banking, it's related to underwriting services, merger and acquisitions, or particularly capital advising services, or capital raising services, or financial advising services, right? These are the key activities over there in the case of the investment banking over there. Okay, now let's learn about the portfolio manager. Now, portfolio manager is actually whom? He's a financial professional. He's a financial professional who is having the knowledge related to the market. So they are going to analyze the market, and based upon the different trends in the market and further the objective of the client over there, they'll be making different decisions on behalf of the clients and institutions so as to achieve the specific objectives, financial objectives, and also at the same time they are going to manage the risk involved over there, right? So what is the role of portfolio manager? They will offer the portfolio management services. So portfolio manager will be offering the PMS, that is a portfolio management services, will be offered so that they can be giving a particular rate of return to their customers, to their clients over there, and also so as to manage the risk. They're not only to give the return, but they're also to manage the risk over there. And particularly they will be drafting an investment policy statement that how the investment will be made so as to understand the client's proposal or client's financial position related to the same, and further they'll be ensuring that the required return are aligned with the risk profile of the customer. Let's say guys, I am basically a client and I'm saying that I want to basically want you to manage my portfolio, but at the same time I want the particular VAR not more than 5% of overall my capital portfolio size over there. Now in that scenario, the portfolio manager must be looking for only for those set of securities and investment where the risk objectives are also met up with, right? And further, that's the main funda. Now let's have a look at the advantages of portfolio management services over there. Definitely professional management is there, customization can be there because individual is managing, the professional is managing, they can be giving us tailored solutions for the same related to our goals, related to risk tolerance, something like that, right? And further, there is continuous monitoring by the professional over there, and they're also trying to manage the risk over there. There is total transparency whatsoever the decision will be taken, and also diversification of the risk will be there. So these are the different benefits or advantages which are available in the case of PMS over there, right? So that will be all related to this particular video. I hope that you must have enjoyed the content of this particular video. So do rate this video out of 10, and for the do like this video and share this video, and do join right now. The link is available in the description box also, and also I'm writing on the screen, that is JAIIB dot learning sessions.in. So simply just visit the website JAIIB dot learning sessions.in and further sign up over there, and on sign up you'll be getting the free access to all the PDFs of all the 4 papers of JAIIB. And that will be all. Thank you so much, and see you again in the next video.